Okay, J. Cage, with another one, a wealthification course based on equity finance. I always tell people I'm not really a teacher, nothing like that. I'm like to be the light, the enlightenment one. That enlighten people to certain things, let that bulb go off. And I used to get a lot of people caught up in the hype talking about how the rich and the wealthy folks they borrow money and they get in debt, and that may be true to a certain extent, but what a lot of people don't know is the opposite of debt financing is equity financing. And what happens is from individuals and credit investors and big institutions and so far and so on, when they want to buy up another company or when these startups want to raise capital, private hair, go public, they issue in stocks. And I'm big on trying to inform our people on how to issue our own securities from bonds and stocks and so far and so on. So, a lot of times, people just believe like it's only one way, debt, debt, debt. You know what I'm saying? And I'm not here to dispute that, but in our community and through the public timeline, through social media, I don't see too many people that look like me that's talking about equity finance. And that's what wealthification is based on, equity, showing you, how to create shares for yourself and let the company issue them back to you. And, you create your in-house banking system or whatever it may be, in-house financing. Everything you go back to is based on shares, stock. You know what I'm saying? And that just represents ownership, equity. So right here, we're gonna go into equity financing versus debt financing. We all should know what debt financing is. Going to the bank, good credit, PG, borrowing some money. Traditional, we've been taught that. And for years, I went against it. I was just building a system, you know what I'm saying? Unfortunately, I had a little enough money to put behind my own ventures and things like that. I was more focused on not getting the debt tied to sitting I could pay the debt back, right? But I always want to know how can I attract investors? Because I kept seeing these big tech companies and like Facebook, etc., that was getting this type of funding. I'm like, these companies ain't borrowing no money. I knew that much. And I always been involved with, private health companies like the YTB, your traveling bed with the employee option stock and the public trade company. So I kind of always been in tune with this. So my thing was always like position myself and then, sell stock off. You know what I'm saying? So now, pretty much equity financing is the sale of stocks and shares to investors. And why I say stock and shares, because stock is more like this stock, this block, and we divide it up into shares. So your founders, co-founders, and executives and early investors and top managers that have more of a stock when it start trading around to other individuals. If it go public, you got shares floating around. Okay, so you got a block of shares that be distributed 50,000 shares at a time and so forth and so on. So now the most important thing is I want to talk about the main three types of investors. It's going to be retail, accredited, and institutional investors. And what a retail investor is, someone that we come across on a regular that invest into the stock market, the crypto market, forex market, pretty much resident real estate, things of that nature. That's more your retail investor. The SEC look at them as, anything less than, I'm gonna just say $1 million, that they worth $1 million, or they less than $1 million, less than being worth $1 million on paper. And not saying that these retail investors don't have millions of dollars and may, have a credential like their credit investor, but they just don't understand the difference between a retail and a credit investor. So that's me and my guy Troy, y'all. We always trying to, sit down with different guys and people that may be potential, clients of us that want to come in on partnerships and kind of let them see how they could become a credit investor, because we is operating in the institutional capacity as we speak on Paper Circle. So with that being said, okay, a credit investor is someone who worth $1 million or more on paper. They made $200,000 in the last 2 years, excluding their residence. So if I live in this property and I got $750,000 worth of assets and they value them, and I'm saying this house worth $250,000, that's excluded. They're excluded for some strange reasons, not included to your network. But you have a corporation you can set up with $1 million or more, $5 million, and you can use that. Institutions is anybody that trade large securities. So banks, insurance companies, and big corporations, and like I say, because institute mean initiate. So that's why I say Paper Circle is an institution. You know what I'm saying? So the thing is, just position yourself to get different, things that retail, when you deal in retail, certain doors that you can't get into. But being a credit investor, you get different options. And the thing with the SEC is that they feel like a credit investor would be more sophisticated retail investor. They worked in big corporations before, worked on a board, they familiar with security. So if they come put this type of money in somebody's hands like me and something go wrong, they feel like they're more aware than a retail investor because they're not really into securities like the credit investors are supposed to be. So now, most VCs like C Corps. Why? I'm gonna tell you why. For one, preferred stock. And when they come in with their foundation or entity, when they get their dividends, when people say that the C Corp is double taxation, where when you get your dividends or interest back from your C Corp, of course that's another taxation, but you get it from another entity, right? It's not coming to an individual. So that's the loophole around the double taxation with the C corporation, right? And another thing, they come in and they put, just say, $10 million in this venture, and they flop. Well, they can write that off on the hit and offset their books. You know what I'm saying? So that's why they don't really care for C or S corps and LLCs. Not saying you can't get funded with LLC or S corp, but they prefer C corp, but they consider a vanilla corporation. But before you get to the VCs, you will be actually operating first with angel investors, in most cases seed funding. What angel investors is the opposite of, they call big checkbook venture capitalists. These guys, they come in, they might bring a couple of $100,000. Either maybe they group themselves up, but they're more of your guys like your dentists, doctors, entrepreneurs, people from the community you may know, people on the internet you make it come across. They want to mentor somebody, guide you, and just give back to the community. They might want to invest, tens of thousands in your company, whatever it may be. They get it running with you and stuff. Then they step down, and the next thing you know, these ventures come in. Venture capital, they let it come in, and they want performance. They won't push this baby in the next 4 or 5 years because these investors ain't trying to stay in your company forever. They just want to get in, and get their share and go into the next venture. You know what I'm saying? So when I look at a company in my sick mind, I look at it like this: ABC Inc. The average company, to me, probably gets on this side. You got equity and you got debt. Equity represent a asset, debt represent liability. You understand the offset it? One wash the other one off. Okay. So over here, you got equity where you issue preferred stock. Over here, you got bonds and loans, which bonds are considered indebtedness. And you got hybrid security, which is convertible bonds that could be transferred into common stock. You got to be careful because they could transfer into more ownership, and you give all your ownership away. You may not want to be unless you got controlling, super vote shares. You know what I'm saying? So a C corp, a C corp, like I say, is the main topic today. So a corporation in general can issue a minimum of 10 million shares at 0.00001, I believe, a fraction of a penny. A C corp can issue 2 types of shares: preferred stock and common stocks. So over here, it works like this. When you first start tracking investors or whatever, they probably get a dividend because they're going to get a preferred stock, non-ownership. But they're the first creditor. Only if no debt was issued. So if this company ain't borrowed no money, they ain't doing wrong, they going to get there before this guy who's going to get this common stock. Okay? And the thing is, this company go south, okay, the person that got the preferred stock will liquidate most of their money first. So that's the beauty about preferred stock. It's a second class. It's another class of stock. Now, over here, when you say your second batch of stocks or shares, it might be common stock, represent ownership. So I might say you're 80% of my company, but I got super vote and controlling share. So you can't kick me off the board, none of that motherfucking shit. You know what I'm saying? So that's the beauty about that. And it's starting to be a tech trend. You know what I'm saying? So over here you got the dividends. So that's come out the prorating. And we talking about private held capacity companies right now. And we talking about the people that we going public. We just talking about equity financing because we talking about private held company that might be getting millions to billions out like Uber did. So now, this how it's gonna work. Okay, we gonna get to the money now. So this how it work. So over here, your first investors come in and acquire 50,000 shares at $3. That's 150,000 funding. You might have given them a 10% dividend in the prorating account. So my guy called, he said, so you tell me if I sold 50,000 shares at $3, that's $150,000. I said, yeah, you get me, you catching on. Exactly. Okay, so a lot of times this stuff ain't make sense to a lot of people that I was bringing it to, but they start seeing like, okay, it's another option, Cage. Okay, So now your second investor come in and acquire 100,000 shares at $10. That's $1 million in funding. You might offer 10% dividend too. Now you got an option to give him. He bought common stock. He might be getting interest. You know what I'm saying? So how they get paid? They get paid because this company, we see Wall Street doing all the time, these tech companies saying on paper it's $100 million. They multiply because everything's a multiple. It's a multiple of 10. We're $1 billion. But now by the time we deduct all the expense from $100 million on $10 million company to a $5 million minimum net profit company to pay back investors, projection. So the company ain't never been making no money, but it's been raised all this money. Now, this Pope in the field we talking about, $5 million. And we saying that we're gonna pay them back with this the first investor money, this the second. But we don't want to do this. This Robert Peter paid Paul. We talking about $5 million right here on the project. Because everything in corporate America is based on present value and future value. So when people are trading stocks, they're buying into the future. They're buying it. They saying this stock is gonna go up, and we know the market go up and go down. But we talking about just general public trading. We talking about private held companies right now. So it's all based on a projection. So what this money is for, because we understand the word money can be transferred into capital. So working capital is for working capital because you got payroll expense, you have a real team around, you got legal fees, you got the attorneys, you got contracts now, you got people that got to be paid now. You know what I'm saying? Expansion, money for expansion, or it's for growth. These are some of the things that when you raising capital, why these guys getting all this money, because they putting it to use, you know what I'm saying? And they trying to get this company up to become a profitable company or just, bring it to the moon. So who the best guy to help you do this? A securities attorney. Well, a security attorney. He help you draft up all your documents you need dealing with your security. You issue bonds, you issue stocks. Like for us, we got a hedge fund company, me and my partner. And the biggest thing with my investment company is find security attorneys because I'm big on issuing what securities. You know what I'm saying? So that's why you got a security attorney. Good corporate attorney can do it, but he'll fit better for what I'm trying to do. Okay, you got an investment banker. He's the guy that come in. You know what I'm saying? You got all these other big investors on his, call. He can call at all times and suddenly come on his radar. He can pull them together. He gonna underwrite the stock anyway. So once he find the next investor, the next group, he gonna be able to cash out, make him some money. Bam, investment bank, which the two big to fail banks were the Lehman Brothers, Goldman Sachs, and so far so on. What they do is they help companies go public and raise money. They assist different, they consult different, advise, they get paid a lot of advising fees and things of that nature too, consult fees probably too. So who else you can get? A consultant firm, because when you're dealing with a consultant firm, it's more your partnership. Advice is just somebody give you good advice, but they're not all the way in the mix with you. So you gotta be careful you saying the word advise, consult, you know what I'm saying? So you get consultant firms, you got venture capital consultant firms, you got anything you're trying to do, you always find a consultant firm. The beauty about when you start your consultant firm, there's no limit how much money that you charging someone to consult them. And that's one of the loopholes when you dealing with your consultant firm with your own company. So with that being said, check out wealthication.org. And this is another beautiful course by JK, Wealthication, based on equity financing versus debt financing that most people are already familiar with. Get a good credit score, pay that score, sign the PG, etc. And that work because I'm using microfinance and dealing with that myself. But this is my favorite side. I found something just as better as the insurance policy collateral, but I'm still just holding on to this, just, still using this for another funding tool. So check it out. Let it marinate. And we can marinate on this, one of my favorite subjects. Because less people are committed to talk about equity finance. And I'm not talking about just sitting the money outside our community. I'm talking about we structure our own in-house finance game. We can fund the next group, the next youth that's coming up that got these great ideas and teach them and we dominate this market because we dealing with banking. We dealing with finance. So check it out. Get with me. And I hope you enjoyed this course today. 1.